Yeah, I think the Fed has given people a lot of head fakes through the course of the last couple of years, in particular, constantly worrying about whether there would be a crisis ahead, and so always sort of giving guidance on the likelihood of cuts at a time when essentially they respond to the actual data that they see. And so, I think it's easy to lose sight of the fact like the Fed has not changed monetary policy. The Fed has not cut, right? And the Fed, won't cut in the next meeting and probably won't cut in the meeting after that. And so, like, they can say whatever they want. Chairman Powell can get up there and worry till the cows come home. But if PCE is above what their target is and rising, and the unemployment rate is basically stable or very, very, very slowly meandering up, like there's no urgency to cut, and they're not going to cut. And so that's one of the challenges of this whole environment is like most investors would do better to literally not listen to the Fed and certainly not listen to all of those speakers that are out there, which fill the airways and, make for good content on Bloomberg, but like otherwise, like are totally useless in trading markets. And just look at the data. And the data has been very clear, and the Fed responds to the data, and that's what's been going on.
Yeah. Yeah. And some of these people shooting off their mouths on CNBC and Bloomberg are not even voting members this year. It's pretty funny. Like Kashkari, I think he's a fan. He's one of the, I'm not sure if I don't even know, but he's always out there, throwing sound bites. And I think just today he said that the Fed may actually have to, or could, he left open the possibility of rate hikes. I saw some sound bite to that effect. But anyway, how far is the economy from going into recession? And we thought it was imminent in the first quarter of 2023. Well, it's
Yeah.
now Q2 24, and we're nowhere close. We're looking at how far away? When is
I,
it?
well, I think part of the challenge of thinking about the timing of the economy is if kind of everything stays the same right now, like interest rates on the short end stay the same, interest rates on the long end stay the same, we will have this like glacial slowing of the economy that we've basically seen over the last couple of years. And, like we'll have long forgotten this conversation by the time the US gets into a recession, right? And so I think the main question is whether we get something that accelerates that downdraft, the downdraft in the economy. And typically the way that works in a credit driven cycle is that credit is booming and eventually kind of exhausts itself. The combination of tighter monetary policy and just literally the fact that credit is growing so strong starts to slow, and that creates a turn in the economy that's relatively acute. But we don't have that kind of credit growth here. And so we have a much more income driven expansion. And so what's going to change the pace of that behavior is really going to come down to whether households continue to spend basically out of their income. And what will determine that is whether households are choosing to save relative to spend. And what will cause them to save more is basically asset prices will have to go down. And what will cause asset prices to go down? Well, it's probably not, naturally from earnings growth, because the economy naturally is like fine. It's not extreme, but it might underperform earnings growth expectations a little bit, but that's probably not going to make a big deal difference. It's much more likely that interest rates will rise, particularly on the long end, which will then create the asset price declines, which will then increase the savings rate, slow the spending, and start a more acute cycle. And so the answer to your question is less about a time frame, because if we're just working on time under the current conditions, it'll be forever. I mean, long time till we get a slowdown, and much more about ordering, which is if we start to get a meaningful rise on the long end, which can then start to hit asset prices, that's the sort of thing that can accelerate this. We saw a little bit last summer and fall, but it didn't survive because the Fed and Treasury backed off. If we get back into that sort of cycle that we saw then this sort of downturn could accelerate.